Hello everyone, welcome to Tesla Daily News. Today is July 10th, Friday, and the following is the latest Tesla news. According to market data, Tesla shares opened at $393.99, dipped to an intraday low near $390.86, and finished at $406.55, up from the previous close of $394.06 on volume of about 37.7 million shares. Technically, the stock printed a strong bullish candle reclaiming recent resistance. This move suggests buyers defended the sub-400 zone and pushed the price back above short-term moving averages, a constructive sign for momentum traders watching for follow-through next week. However, with the day's high around $407.86, the stock is still just below potential resistance near the recent range highs, so traders will be watching whether Tesla can break out decisively or slips back into consolidation. According to Welt, Tesla has staged an impressive comeback in the German electric vehicle market, emerging as one of the major winners of Germany's current EV boom. German consumers are buying more electric cars than ever, heavily supported by state-funded purchase subsidies, and Tesla is capturing a disproportionately large share of that demand. While some German legacy automakers struggle with profitability and rely on steep discounts, Tesla benefits from sustained demand for its Model Y and Model 3, strong brand recognition, and efficient cost structures that allow it to compete without the same level of discounting pressure. For investors, the key takeaway is that Germany's subsidized EV expansion is translating into real volume gains for Tesla, reinforcing its competitive position in one of Europe's most important auto markets and supporting revenue growth in the region. According to EU Observer, Germany has effectively bankrolled Tesla's German operations and customer base with substantial public money, both through buyer subsidies and direct factory support. Between 2020 and 2023, German EV purchase subsidies channeled an estimated €860 million to buyers of Tesla vehicles. These subsidies were part of Germany's strategy to meet green targets linked to EU COVID recovery funds, meaning that every subsidized Tesla helped Germany unlock EU refinancing tied to climate objectives. At the same time, Tesla's Gigafactory near Berlin is now receiving over €71 million in state aid, including 3 scheduled tranches from the state of Brandenburg approved under an EU crisis and transformation framework. This funding picture is politically sensitive because Elon Musk has publicly criticized the EU, attacked its institutions, and voiced support for far-right political forces in Germany, creating tension between his rhetoric and the fact that his company benefits significantly from European and German public funds. From an investor perspective, however, the core message is that Tesla's German manufacturing footprint and local demand are underpinned by large, ongoing state support, which helps de-risk the Berlin Gigafactory, improves local cost competitiveness, and reinforces Tesla's role in Europe's EV industrial strategy despite the political controversy. According to Frankfurter Rundschau, the German EV market is undergoing a dramatic reshuffle, with Tesla's competitive stance shaped by an intense price war among manufacturers. Recent data from Germany's Motor Vehicle Authority show that Volkswagen remains the top brand for new EV registrations, while BMW has climbed back to second place after heavy discounting. Tesla now ranks behind Volkswagen and BMW in quarterly registrations, with around 16,000 new Teslas registered in Germany in the second quarter compared with higher figures for Volkswagen and BMW brands. The article emphasizes that BMW and Tesla are both leaning on aggressive price cuts to sustain or regain market share. Tesla trimmed prices of Model Y and Model 3 by several thousand euros around the turn of the year, which quickly boosted volumes and LED to Tesla selling about 1.5 times as many vehicles in the first half of this year as in the whole of 2024 in Germany. However, the report questions the profitability of this strategy, noting that when so-called premium manufacturers rely on steep discounts to move older models, it may reflect weakness rather than strength. For Tesla investors, this underscores a core strategic tension. The company can drive strong volume growth in Europe by cutting prices, but the sustainability of margins in a prolonged price war remains a central risk. According to EU Observer and Welt, the same German policy mix that pressures local incumbents appears to be amplifying Tesla's gains. Germany uses EV subsidies to meet EU climate-linked obligations, indirectly rewarding Tesla's early move into large-scale EV production and its fast ramp in Berlin. While some analysts worry that European subsidies effectively enrich a foreign competitor, the immediate investment angle is that Tesla enjoys both strong demand pull from incentivized buyers and structural support from having a major production hub inside the EU single market. The combination of lower logistics costs, potential access to future EU-wide incentives, and rapidly improving local supply chains could keep Tesla highly competitive in Europe even as subsidies gradually taper off and Chinese brands push harder into the market. According to HISA, Tesla is aggressively ramping production of its steering wheel-less cybercab Robotaxi in Texas even though the vehicle currently cannot operate as intended under existing regulations. The company has already built over 100 units of the two-seat cybercab, which are reportedly parked around the Texas Gigafactory site. Despite this, Tesla is not yet allowed to sell the vehicle to private customers, and its deployment in designated Robotaxi test zones in Texas and Florida remains tightly constrained. Tesla began early cybercab test drives around Austin in late June, reportedly with a human minder on board, though the vehicle lacks both a steering wheel and accelerator pedal, raising questions about how a person could intervene in an emergency. Tesla has been testing a broader Robotaxi fleet in Austin since mid-2025, but only a small fraction of roughly 50 vehicles are currently operating without a human safety rider. Additional pilot programs have started in Dallas, Houston, and Miami, though Tesla is proceeding cautiously. Tesla chief executive Elon Musk has told investors that the company is holding back wider Robotaxi deployment until a major upgrade of its full self-driving software, version 15, is ready. That update is expected around late 2026 or early 2027, with Musk projecting that meaningful revenue from Robotaxi services is unlikely before 2027. For investors and enthusiasts, this means Tesla is committing capital and production capacity now in anticipation of a regulatory and technological inflection point several years away. If full self-driving 15 proves robust and regulators allow broader commercial operation, Tesla's head start in purpose-built Robotaxis like the Cybercab could translate into a powerful recurring revenue platform. Until then, however, the Cybercab program remains a high-risk, high-reward bet with limited near-term cash flow. According to Finanzen.net, SpaceX has received the worst possible ESG rating from index provider MSCI, and Elon Musk responded with technical sarcasm that highlights how ESG metrics intersect with his broader ecosystem of companies, including Tesla. MSCI assigned SpaceX a CCC rating, the lowest on its scale, citing three main issues: emissions risks from rocket launches, weak sustainability management, and poor corporate governance. Governance metrics were especially low, with SpaceX scoring just over 3 points out of 10, and the company received an orange flag in the controversy category, signaling serious ongoing issues. The timing was sensitive because MSCI published its assessment just one day before SpaceX's $75 billion IPO. Musk's public reply on his social platform X was brief. He wrote that unfortunately, electric rockets are impossible, directly mocking the emissions component of the rating. Technically, modest thrust electric propulsion such as ion and Hall effect thrusters already exist for satellites, and SpaceX uses them on Starlink spacecraft, but they cannot deliver the high thrust required to lift rockets from Earth's surface. Critics argue that current ESG frameworks do not adequately account for physical constraints in high-thrust industries like orbital launch. This matter is relevant to Tesla shareholders because Musk's personal brand and governance style span Tesla, SpaceX, and X's CCC rating may limit SpaceX's inclusion in ESG-focused funds and intensify scrutiny of Musk's control structures and governance practices. At the same time, SpaceX's emphasis on reusability, such as Falcon 9 boosters flown up to 35 times and Starship's planned full reusability and potential use of synthetic methane, points toward long-term emissions reductions per kilogram of payload. These cross-company narratives influence how regulators, investors, and the public perceive Musk's entire portfolio, including Tesla, especially as Tesla continues to attract ESG-oriented capital while its CEO increasingly criticizes traditional ESG ratings. According to the Economic Times, a U.S. federal judge has approved Elon Musk's settlement with the Securities and Exchange Commission regarding his delayed disclosure of Twitter share purchases, while openly voicing concern about the deal's terms. The case centers on Musk's failure to disclose his growing stake in Twitter within the required timeframe in early 2022, a delay the SEC estimates saved him about $150 million as he continued to buy shares before the market understood his intentions. The settlement requires a trust associated with Musk to pay a civil penalty of $1.5 million, which the SEC describes as the largest fine of its kind. Notably, the SEC chose not to pursue disgorgement of alleged ill-gotten gains, and it settled with the trust rather than directly with Musk. The judge questioned whether this arrangement amounted to special treatment, wondering aloud if similar leniency would be shown to other alleged securities law violators and whether the agreement was negotiated without the full involvement of the SEC's trial lawyers. For Tesla investors, the practical impact is that this particular enforcement episode is now largely closed, reducing one piece of regulatory overhang for Musk personally. However, the judge's skepticism about whether Musk received a unique deal reinforces the broader governance and key person risk narrative that surrounds Musk and, by extension, Tesla. Any future regulatory clashes involving Musk, be they at X, SpaceX, or Tesla, are likely to be viewed through the lens of this perceived exceptional treatment and the ongoing debate about whether regulators can or will constrain him effectively. According to the Goulburn Post, Tesla's drive to deepen customer engagement and ancillary revenue streams continues with a new lifestyle-oriented accessory, an official air mattress tailored for the Model 3. In the United States, Tesla has launched a genuine accessory mattress that fits precisely across the folded rear seats and trunk area of the Model 3. It is constructed from 3-inch high-density foam with a waterproof polyester cover, includes an integrated air pump, and comes with a carry bag and repair kit. The product quickly sold out shortly after launch, signaling strong demand among Tesla owners who use their vehicles for camping, road trips, and outdoor activities. Although third-party mattresses exist, Tesla's design claims a better fit with the vehicle's contours, and the company already offers similar official accessories for the Model Y and Cybertruck in certain markets. In Australia, Tesla's overall sales momentum has been striking. In June, the company sold 8,670 vehicles, making Tesla the fourth best-selling brand for the month, with the Model Y alone topping the national sales charts as the best-selling vehicle of any type. Year-to-date, Tesla's Australian sales have climbed more than 66%, pushing it into the ranks of the country's top 10 brands. For investors and enthusiasts, this story matters not just as a quirky accessory launch but as evidence of Tesla's powerful ecosystem and brand stickiness. High-margin accessories and lifestyle products can lift profitability per vehicle, while record sales and brand rankings in markets like Australia demonstrate that Tesla still has ample room for growth outside North America and Europe. The rapid sell-out of a premium-priced, non-essential accessory underscores how engaged the owner community is and how effectively Tesla can monetize that loyalty over time. According to Bloomberg, the cost of owning a Tesla in Singapore has reached extraordinary levels due to that country's strict vehicle quota system and a spike in permit prices. Singapore requires car buyers to obtain a Certificate of Entitlement, or CE, which grants the right to own a vehicle for 10 years and is auctioned in limited quantities. Recently, the CE price for smaller cars has surged to a record around 129,000 Singapore dollars, and this has pushed the all-in cost of an entry-level Tesla Model 3 with a 10-year permit to about 203,411 Singapore dollars. For comparison, the same model the United States starts at roughly $36,990, highlighting how dramatically local regulation and taxation can inflate ownership costs. The Land Transport Authority in Singapore has warned that upcoming policy changes and reduced EV rebates could further support high CE prices as buyers rush to bring purchases forward. While Singapore is a small market in absolute volume terms, this story illustrates a broader theme for Tesla investors. Local regulatory frameworks, taxes, and incentive schemes can strongly influence demand and pricing power, sometimes making Tesla's aspirational luxury products in certain regions even as the company pushes for mass-market adoption elsewhere. According to Frankfurter Rundschau and EU Observer, these mixed policy environments from generous EV subsidies in Germany to punishing ownership costs in Singapore underscore the increasingly political nature of Tesla's global expansion. Governments eager to hit climate targets often support EV adoption through subsidies and tax breaks, which directly boost Tesla's volumes, as seen in Germany and Australia. At the same time, controversies around Musk's political statements, his clashes with EU institutions, and questions about subsidies flowing to accompany LED by a vocal critic of the EU show that regulatory goodwill is not guaranteed. For long-term investors, the implication is that Tesla's fortunes will hinge not only on product innovation and manufacturing efficiency but also on how well the company navigates different political climates, regulatory regimes, and social expectations across its major markets. The current news cycle highlights that Tesla remains at the center of debates over industrial policy, climate action, corporate governance, and free speech, all of which can feed back into investor sentiment and valuation. Thank you for listening to Tesla Daily News. If you enjoyed this episode, please consider subscribing so you do not miss future updates.